Inheritance tax. The 2027 pension rule. Change that will cost your family thousands. In April 2027, a rule change comes into force that will fundamentally alter how pension wealth is taxed on death in the UK. For decades, your pension has sat outside your estate for inheritance tax purposes. It's been one of the most powerful and most legitimate wealth transfer tools available to UK families. You could accumulate £300,000, £500,000, £800,000 in a SIP, leave it largely untouched, and pass it to your children or grandchildren completely free of inheritance tax. From 6th April 2027, that changes. Unused pension funds will be brought inside your estate for IHT purposes. And if your total estate, including your home, your savings, your investments, and now your pension, exceeds the IHT thresholds, the excess will be taxed at 40%. HMRC's own figures estimate that the average IHT liability will increase by around £34,000 for affected estates when pension assets are included. For families with larger pension pots and existing property wealth, the figure can be significantly higher. In this video, I'm going to explain exactly what's changing, who it affects, how much it's likely to cost, and, most importantly, what you can still do before April 2027 to protect your family's inheritance. Because the window to act is open right now, but it is closing. Section 1. How the current rules work. And why this change is so significant. To understand why this change matters so much, you first need to understand how the current system works. Right now, most defined contribution pensions, SIPs, workplace pensions, personal pensions, sit outside your estate for inheritance tax purposes. This is because of the way they're structured. Most pension schemes are written under discretionary trust, which means the assets are legally held by the trustees of the scheme, not by you personally. Because they don't form part of your personal estate, they fall outside the reach of IHT. In practice, this has meant that a pension pot, however large, can be nominated to your chosen beneficiaries and passed to them free of inheritance tax. If you die before age 75, the beneficiaries typically receive it completely free of income tax as well. If you die after 75, the beneficiaries pay income tax on withdrawals at their marginal rate, but still no IHT. This created a powerful planning opportunity. Many people, particularly those with other income sources in retirement, such as a defined benefit pension, rental income, or significant savings, deliberately drew minimally from their SIP, preserving it as a tax-efficient vehicle to pass wealth to the next generation. The government has decided that this has gone too far. Their position, set out clearly in the 2024 autumn budget, is that pensions are designed to fund retirement, not to serve as an inheritance tax shelter. From April 2027, they're acting on that position. The change is not a consultation anymore. Legislation has been drafted. The July 2025 government response confirmed the details. Draft finance bill clauses have been published. A reversal, according to every financial planning commentator I've seen, appears extremely unlikely. This is happening. The question is what you do about it. Section 2. Exactly what changes. On 6th of April 2027. Let me be precise about what the new rules actually say, because there's been some confusion in media coverage. From 6 April 2027, unused pension funds and pension death benefits will be included in the value of your estate for inheritance tax purposes. This applies regardless of whether the pension scheme has discretion over who receives the benefits. The key word is unused. Money you've already drawn from your pension and spent or invested in an ISA or given away. That's already left the pension and is subject to the normal rules for whatever it became. It's the money still sitting inside your pension pot at death that is now caught. Here's what remains exempt. Benefits passing to a surviving spouse or civil partner remain entirely exempt from IHT, just as they are for other assets. The spousal exemption is maintained in full. This is critically important, and I'll come back to its planning implications shortly. Death in service benefits, lump sums paid from a pension scheme because you die while still employed, are excluded from the changes and will not be subject to IHT. Dependent scheme pensions from defined benefit arrangements are also excluded. Here's what is caught. Unused defined contribution pension funds. Everything still sitting in your SIP, personal pension, or workplace defined contribution scheme at death. Pension death benefits payable to anyone other than a spouse or civil partner. Your children, grandchildren, siblings, or anyone else you've nominated. Now let's look at the IHT thresholds, because your pension only becomes taxable if your total estate exceeds them. The nil rate band is £325,000 per person. The resident's nil rate band adds a further £175,000, where a residential property passes to direct descendants. For a married couple, these allowances can be combined on the second death, giving a potential combined threshold of £1 million. From April 2027, your pension pot sits inside those thresholds, not outside them. Section 3. The real numbers. How much will this actually cost? Let me show you what this looks like in practice with some realistic scenarios, because the numbers are what make the impact tangible. Scenario 1. The single retiree. Margaret is 72. She's single, widowed. She has a home worth £380,000, savings and ISA investments of £60,000, and a SIP worth £320,000 that she's drawn minimally from because her defined benefit pension covers her living costs. Under current rules, Her estate for IHT purposes is £440,000. The house and savings. Her nil rate band is £325,000, and her residence nil rate band brings the threshold to £500,000 because she's leaving the house to her adult children. Her estate is below the threshold. No IHT. From April 2027, her pension pot of £320,000 is added to her estate. Total estate, £760,000. Threshold, £500,000. Taxable amount, £260,000. IHT at 40%, £104,000. Her children's inheritance falls by over £100,000, not because anything changed about her assets, simply because the rule changed about how her pension is counted. Scenario 2. The married couple, second death. David and Susan are both in their early 70s. They have a jointly owned home worth £550,000, combined savings of £120,000, and David has a SIP worth £450,000, which he has preserved carefully as a legacy for their 3 children. When David dies, his pension passes to Susan under the spousal exemption. No IHT. Susan now has the house, the savings, and the £450,000 pension in her name. When Susan subsequently dies, her total estate is £1,120,000. The combined nil rate bands for a surviving spouse are £650,000, plus the resident's nil rate band of £350,000 gives a total threshold of £1,000. Taxable amount, £120,000. IHT, £48,000. Before April 2027, the pension sat outside the estate. Susan's taxable estate was £670,000. Below the threshold. No IHT at all. The change cost this family £48,000. Scenario 3. The larger pension pot. Robert is 68, divorced, and has accumulated a £700,000 SIP over a long career. He has a house worth £400,000 and other assets of £80,000. He has 2 adult children he wants to provide for. Under current rules, estate of £480,000. Threshold £500,000. No IHT. From April 2027, estate of £1,180,000. Threshold £500,000. Taxable £680,000. IHT at 40%, £272,000. His children's inheritance is reduced by £272,000. That's life-changing money. A house deposit eliminated, a business investment wiped out, a financial legacy destroyed. These aren't edge cases. HMRC estimates that approximately 38,500 estates per year will pay more IHT as a result of this change, with 10,500 facing an IHT charge where previously they would have had none. The average increase in liability across affected estates is approximately £34,000. Section 4. The double tax problem. IHT and income tax together. There's a dimension to this change that receives less attention than it deserves, and it's the interaction between inheritance tax and income tax on inherited pension funds. When a beneficiary inherits a pension and draws from it, they pay income tax on those withdrawals at their marginal rate, if the pension holder died after age 75. So let's say your adult child inherits your SIP. They pay 40% IHT on the pension as part of your estate. Then, as they draw from what remains, they pay income tax at their own marginal rate, potentially 20%, 40%, or even 45%. The effective combined tax rate in the worst case, a higher rate tax-paying beneficiary inheriting from someone who died after 75, can approach 60% to 67% of the original pension value. To put that starkly, for every £100 sitting in your SIP at death, your higher rate tax-paying adult child might ultimately receive £33 to £40. This is the reality of unplanned pension inheritance under the new rules. It's not a hypothetical. It's the mathematics of 2 tax systems operating simultaneously on the same asset. This is why the strategies I'm going to cover in the next section are so important. The goal isn't just to minimise IHT, it's to ensure that pension wealth passes to your family in the most tax-efficient form available, which may mean converting pension wealth into other asset types before death. Section 5. What you can do about it. The strategies that still work. The good news is that there is still time to act. April 2027 is not far away, but for most people reading this, there are meaningful steps available right now. Here are the strategies worth considering. Strategy 1. Draw down more from your pension during your lifetime. The simplest and most direct response. If your pension is likely to form part of a taxable estate, drawing it down faster during your lifetime, while you're alive and able to control the tax on withdrawals, puts you in charge of the tax rate, rather than leaving it to IHT at 40%. Withdrawals from your pension are subject to income tax at your marginal rate. If you're a basic rate taxpayer, that's 20%. If your withdrawals keep you within the basic rate band, up to £50,270 total income in 2025 to 26, the effective tax rate on each pound withdrawn is less than half the IHT rate. Drawing down strategically and placing the proceeds into an ISA, where future growth and withdrawals are completely tax-free, moves wealth out of the IHT net into an entirely tax-free environment. The annual ISA allowance is £20,000 per person. A couple can shelter £40,000 per year between them. This is exactly the kind of coordinated strategy the Drawdown Planner inside Retirement Ready UK is built to model. You can map your pension drawdown alongside your ISA contributions See the projected tax cost of different withdrawal rates and identify the strategy that moves the most wealth out of the IHT net at the lowest tax cost. Link in the description. Strategy 2. Make regular gifts from pension income. Where pension withdrawals combined with other income generate a surplus, more than you actually need to live on. Those surplus withdrawals can be given away to family members as regular gifts from surplus income. HMRC's inheritance tax rules include an exemption at IHTM Form 4231 in the IHT manual for regular gifts made from income rather than capital, provided they don't reduce your standard of living. These gifts are immediately outside your estate. There is no 7-year waiting period. In practical terms, if you withdraw £30,000 from your SIPP this year, spend £18,000 on living expenses, and give £12,000 to your children as a documented regular gift, that £12,000 never touches your estate. It's gone from your pension, not added to your estate, and given away under a legitimate IHT exemption. This requires careful documentation. HMRC expects a clear pattern of regular gifting from income, not ad hoc lump sums. But for those with surplus pension income, it is a powerful strategy. Strategy 3. Use the annual gift exemption and 7-year rule. Every individual can give away £3,000 per year, completely free of IHT, the annual gift exemption. If you didn't use it last year, you can carry it forward and give £6,000 this year. A couple can give £12,000 combined. Larger gifts, above the annual exemption, become fully exempt from IHT if you survive 7 years from the date of the gift. Between 3 and 7 years, taper relief reduces the IHT charge. The clock starts the moment the gift is made. If you're considering making significant gifts to family members, starting sooner gives the 7-year clock more time to run, and before April 2027 makes your pension pot more of an IHT concern. Strategy 4. Review your expression of wishes and beneficiary nominations. This doesn't reduce your IHT liability, but it can significantly affect how the liability is managed and which beneficiaries are most affected. Where pension benefits pass to a surviving spouse or civil partner, they remain exempt from IHT. This means for married couples, nominating the spouse as primary beneficiary on the first death remains a powerful planning tool. The surviving spouse receives the pension, IHT-free, then manages their own drawdown and gifting strategy, knowing the full changed rules. Review your expression of wishes with your pension provider. Ensure it reflects your current family circumstances and your intentions under the new rules. An outdated nomination form can result in pension benefits going to unintended recipients or being paid in a way that maximizes, rather than minimizes, the IHT exposure. Strategy 5. Consider whole-of-life insurance written in trust. For those with significant pension wealth in estate, IHT exposure, a whole-of-life insurance policy written in trust, can provide a lump sum on death specifically to cover the IHT liability. The policy sits outside your estate because it's in trust, so the payout goes directly to beneficiaries to meet the tax bill. The premiums are paid from income. The payout is IHT-free, and your beneficiaries receive the full inheritance, with the insurance covering what would otherwise go to HMRC. This is a specialist product that requires professional advice. The cost-benefit analysis depends on your age, health, and the size of the likely IHT liability. But for larger estates, it's worth exploring as part of a broader plan. What probably won't work, and a word of caution. There has been significant commentary about whether pension assets could be moved into trust structures before April 2027 to escape the new rules. The government anticipated this during consultation and included anti-avoidance provisions in the draft legislation. Attempting to use trust structures to circumvent the change carries its own tax risks and is an area where professional legal and tax advice is essential before taking any action. Anything that sounds like a simple way to avoid the change entirely should be approached with considerable skepticism. Section 6. The administration burden. What your family will face. Beyond the tax cost itself, there's a significant administrative burden that the new rules place on families at an already difficult time. Under the new regime, it is the personal representatives, typically the executors of your estate, who are responsible for reporting and paying IHT on unused pension funds. Not the pension scheme administrator, your executor. This means your executor needs to identify all pension schemes you held, notify each scheme administrator of your death, establish the value of unused benefits, determine whether IHT is due, calculate the liability, and coordinate payment, either from the estate, from the pension scheme directly, or from beneficiaries. HMRC has said it will provide a calculator and guidance to help with this, and pension scheme administrators will have new duties to support personal representatives. But this process will involve multiple parties. Your executor, potentially multiple pension providers, HMRC, and your beneficiaries, at a time when your family is managing bereavement. The practical message from this is twofold. First, make sure your executor knows about all your pension arrangements, scheme names, providers, approximate values, and the location of all relevant paperwork. Second, if your estate is likely to be complex, consider whether your executor needs professional support, a solicitor, or tax advisor to manage the IHT process correctly. Keeping an up-to-date expression of wishes with each pension provider and maintaining clear financial records are simple steps that could save your family significant stress and delay when the time comes. Section 7. Who is most affected and who isn't? 1830-1930. Before I close, let me be clear about who this change primarily affects, because it's been somewhat overstated in parts of the media, and I want to give you an accurate picture. Most estates will continue to have no IHT liability after April 2027. If your total estate, including IHT, including your pension, remains below the applicable nil rate bands, nothing changes for you. The change primarily affects people who have accumulated large pension pots, typically £200,000 or more, and who also have significant other assets, particularly property. It disproportionately affects those who have deliberately preserved their pension as a legacy vehicle rather than using it for retirement income, and it particularly affects the second death in a married couple, where the combined estate, including an inherited pension, is more likely to breach the thresholds. If you have a modest pension pot, a standard house, and no significant other assets, the chances are this change doesn't create a material IHT problem for you. But if you have a pension pot of £300,000 or more, and property or other assets alongside it, the combination may now push your estate over the threshold in a way that wasn't previously the case. Running your own numbers, modelling your full estate including the pension, is the essential first step. The Retirement Ready UK estate planning tool lets you map your complete financial picture, including pension, property, ISAs and other assets, calculate your projected IHT position under the new 2027 rules, and model the impact of different drawdown and gifting strategies on your estate. It's an important tool for anyone who wants to understand their specific exposure before April 2027. Link in the description. April 2027 isn't far away, and the decisions made in the period between now and then will determine how much of your pension wealth reaches your family and how much goes to HMRC. The core message of this video is simple. Your pension is no longer outside your estate. If your total estate, including your pension, unused exceeds the IHT thresholds, the excess will be taxed at 40%. And if your beneficiaries then pay income tax on withdrawals from an inherited pension, the effective combined rate can be devastating. But this is not a situation without options. Drawing down strategically, gifting from surplus income, reviewing beneficiary nominations, and coordinating pension withdrawals with ISA contributions are all legitimate and effective responses. The key is understanding your specific exposure and acting before the window closes. I'd encourage you to do two things after watching this video. First, check your expression of wishes with your pension provider. Make sure it reflects your current intentions and family circumstances. This costs nothing and takes minutes. Second, model your estate position under the new 2027 rules. The Retirement Ready UK estate planning tool is the fastest way to do that. It brings together your pension, property, savings and other assets in one place and shows you your projected IHT exposure before and after the rule change. The link is below. And if your situation is complex, large pension, significant property, blended family, or substantial other assets, please speak to a regulated financial advisor and a solicitor with estate planning expertise. The cost of that advice is almost always a fraction of the tax it can help you avoid. Hit like if this video is useful. Subscribe for more UK retirement and estate planning content. This is exactly the kind of topic this channel covers in depth. I'll see you in the next one. The SIP drawdown strategy that could save you £50,000 in tax. Here's a question I want you to sit with for a moment. If someone told you there was a legal, straightforward strategy that could reduce your retirement tax bill by £50,000 over 20 years, and that the strategy required no specialist products, no complex financial instruments, and no accountant charging you thousands of pounds, would you want to know about it? Of course you would. And yet the overwhelming majority of people who retire with a SIP or a defined contribution workplace pension never use it. Not because they can't, but because nobody ever explained it to them. The strategy is simply this: controlling when you draw from your pension, how much you draw each year, and in what combination with your other income sources, so that you consistently pay the lowest possible rate of tax on your retirement income. It sounds almost too straightforward, but the difference between doing this thoughtfully and doing it without a plan is, for a typical retiree with a $400,000 pension pot, somewhere between $30,000 and $60,000 in lifetime tax savings. In this video, I'm going to show you exactly how SIPP drawdown taxation works, the specific strategies that reduce your bill, the mistakes that inflate it, and how to build a withdrawal plan that keeps more of your pension where it belongs, with you. Let's start with the fundamentals, because there's a significant amount of confusion around how pension withdrawals are actually taxed in the UK. When you contribute to a SIPP or a workplace pension, you receive tax relief on your contributions. Basic rate taxpayers get 20% relief added to every contribution. Higher rate taxpayers can claim a further 20% through their self-assessment return. So if you're a higher rate taxpayer, every $60 you contribute effectively costs you $40 after tax relief. That's the upfront benefit. And it's genuinely generous, but here's what people often don't fully internalise. The tax isn't cancelled, it's deferred. When you start drawing from your pension in retirement, those withdrawals are treated as income in the year you take them. They're subject to income tax at your marginal rate, exactly as if they were salary or wages. Now, your first 25% of your pension pot can be taken as a tax-free lump sum, up to a maximum of $268,275 under current rules. Beyond that, every pound you withdraw is fully taxable. So let's say you have a $400,000 IPP. Your tax-free cash entitlement is $100,000. The remaining $300,000 will be taxed when you draw it. At what rate depends entirely on your total income in each year you make withdrawals. This is where most people go wrong. They retire. They look at their pension pot. They decide how much they need each year to live comfortably, and they withdraw exactly that amount, without thinking about how it interacts with their personal allowance, their basic rate band, their state pension, or any other income they receive. The result is predictable. In some years, they pay far more tax than necessary. In other years, they leave their personal allowance and basic rate band partially unused. Over a 20-year retirement, the cumulative cost of that unplanned approach can be substantial. Before we get into specific strategies, it's worth understanding the three variables that drive your SIPP drawdown tax position. Because controlling these three things is essentially the entire game. Variable 1, your total income in each tax year. Income tax in the UK is assessed on your total income from all sources in a given tax year. Your SIPP withdrawal, your state pension, any workplace pension income, any rental income, savings interest, dividends. All of it adds together and is compared against your allowances and tax bands. In 2025-26, the personal allowance is $12,570, meaning you pay no income tax on your first $12,570 of income. The basic rate band then runs from $12,571 to $50,270 with income tax at 20%. Above $50,270, the higher rate of 40% applies. The fundamental goal of drawdown strategy is to keep your total annual income as close to, but not exceeding, the top of the basic rate band for as long as possible. Variable 2, the timing of your state pension. The state pension starts at age 66 and currently pays up to $11,500 per year. That $11,500 counts as taxable income. It consumes a large portion of your personal allowance the moment it begins. Before your state pension starts, you have a window, potentially several years, where your only income is what you choose to draw from your pension. This is a period of significant flexibility and tax efficiency that most people underuse. Variable 3, your tax-free cash strategy. Most people take their full 25% tax-free lump sum on the day they retire. It's the default. It feels safe and logical. Take the tax-free money first, but taking it all at once isn't always the most tax-efficient approach. Phased drawdown, taking a portion of tax-free cash each year alongside a taxable withdrawal, can spread the tax relief across multiple years in a way that keeps total taxable income lower each year. It's a more complex approach, but for larger pots, it can produce meaningful tax savings. I want to spend significant time on this because it is the single most important opportunity in SIPP drawdown planning, and it's almost universally underexploited. Between the day you stop working and the day your state pension begins, you have a window of potentially 5 to 10 years where your taxable income is entirely within your control. If you retired at 60 and delay your state pension to 66, that's 6 years. In those 6 years, your only income is whatever you choose to withdraw from your pension or other savings. Your personal allowance and basic rate bands sit essentially empty until you fill them. Let's look at what this means in practice. A 61-year-old with a $500,000 SIPP, no other income yet. Personal allowance of $12,570. Basic rate band up to $50,270. Option A, unplanned withdrawal. They decide they need $33,000 a year to live on. They withdraw $35,000. After the personal allowance, $22,430 is taxed at 20%. Annual tax bill, $4,186. Option B, planned withdrawal using the full basic rate band. They still need $35,000 to live on, but they recognise that they can withdraw up to $50,970 before hitting the high rate threshold. So they take their $35,000 for living expenses and use the remaining $59,970 of basic rate capacity to make additional withdrawals, either spending the surplus, investing it in an ISA, or simply keeping it in a savings account. Now here's the important question. Why would you withdraw more than you need? Because money inside your SIPP will eventually need to come out and be taxed. Every pound you can extract at 20% today is a pound that can never be taxed at 40% later, if your income in future years is higher due to state pension, rental income, or other sources. Furthermore, and this is particularly relevant for larger pension pots, SIPPs are currently outside your estate for inheritance tax purposes. But from April 2027, the government has proposed bringing unspent pension pots into the IHT net. The landscape is changing, and having a large residual SIPP balance may carry a tax cost that didn't previously exist. Drawing down strategically during low-income years isn't about spending money you don't need. It's about controlling the rate at which the tax is paid. Here are the 5 core strategies for tax-efficient SIPP drawdown. Used in combination, they form a coherent withdrawal plan rather than a series of ad hoc decisions. Strategy 1. Fill your basic rate band every year. In any year where your total income falls below 50,000 you have unused basic rate capacity, deliberately drawing pension income to fill that capacity, and either spending it, saving it, or reinvesting in an ISA prevents that capacity being wasted. Pounds extracted from your SIPP at 20% are pounds that can never be taxed at 40%. Strategy 2. Maximize ISA contributions from pension withdrawals. The annual ISA allowance is $20,000. Pension withdrawals that are then reinvested into a stocks and shares ISA move money from a taxable environment, where future growth will be taxed, into a completely tax-free environment for all future growth and withdrawals. If you're 60 with a $500,000 SIP and 10 years before your state pension, you could potentially move $20,000 per year into an ISA, $200,000 in total, before your state pension begins and reduces your available headroom. That $200,000 inside an ISA generates no further tax liability ever. The compounding benefit of that tax shelter over a 20-year retirement is significant. Strategy 3. Blend tax-free cash with taxable withdrawals. Rather than taking your full 25% tax-free lump sum at retirement, consider using Flexi Access Drawdown to take a portion of tax-free cash each year alongside a taxable withdrawal. Under Flexi Access Drawdown, 25% of each withdrawal is tax-free and 75% is taxable. This approach smooths your tax-free cash over multiple years, potentially keeping your annual taxable income lower in each of those years. For larger pots, it can be particularly effective, though it requires careful modelling because it interacts with the money purchase annual allowance once you access flexible income. Strategy 4. Time large withdrawals in low-income years. If you need to make a larger than usual withdrawal for a property purchase, home renovation, helping children with a deposit, or any other major expense, try to time it in a year when your other income is low. A year when the state pension hasn't started yet, a year between jobs, or a year when other income sources are temporarily reduced. These are the years to take larger pension withdrawals because more of the withdrawal will fall within your basic rate band rather than the 40% band. Conversely, in years when your income is already high, avoid discretionary pension withdrawals if you can. The marginal tax cost is simply too high. Strategy 5. Coordinate with your spouse or partner. If you have a spouse or civil partner, their pension arrangements and income profile are a crucial part of your tax planning. Two people each drawing within their basic rate bands pay significantly less combined tax than one person drawing double the amount and hitting the higher rate band. If one partner has a substantially larger pension than the other, it may be worth that partner drawing down more aggressively in early retirement, filling their own basic rate band, while the other partner's smaller pot continues to grow, or vice versa, depending on your respective state pension ages and amounts. The key principle is to look at combined household income and try to spread withdrawals in a way that keeps both partners within the basic rate band for as many years as possible. Now let's look at the other side. The specific errors that cost retirees thousands in unnecessary tax. Mistake 1. Taking the full tax-free lump sum at retirement and spending it. Taking $100,000 in tax-free cash and then withdrawing $40,000 per year from the remaining $300,000 for living expenses is a perfectly logical approach. But it ignores the fact that spending the tax-free cash first and then relying entirely on taxable drawdown means all future withdrawals are fully taxable. A better approach for many people is to leave some or all of the tax-free cash inside the pension, using the phased withdrawal approach so that a portion of each annual withdrawal continues to be tax-free. Mistake 2. Triggering the money purchase. Annual allowance. The moment you take any flexible income from a SIPP, not just tax-free cash, but actual flexible drawdown, the money purchase annual allowance is triggered. This reduces the amount you can contribute to a pension with tax relief from $60,000 per year to $10,000 per year. If you're still working, or plan to return to work, or have a partner still earning, triggering the MPAA prematurely can be a costly mistake. It permanently limits future pension contributions. Mistake 3. Ignoring the interaction with the personal savings allowance. Basic rate taxpayers receive a $1,000 personal savings allowance, meaning the first $1,000 of savings interest is tax-free. But if SIPP withdrawals push you into the higher rate band, your PSA drops to just $500. If you have significant savings outside your pension, this interaction can cost you more than you realise. Mistake 4. Withdrawing large lump sums on emergency tax codes. When you make your first withdrawal from a SIPP, your provider often doesn't have a tax code for you yet. They apply an emergency tax code, which can result in significantly more tax being withheld than you actually owe. HMRC will eventually refund the overpayment, but it can take months. The solution is to submit a P45 form to HMRC to claim back the overpaid tax promptly, rather than waiting for the end of the tax year. Mistake 5. Not reviewing the plan annually. A drawdown strategy that was optimal at 61 may be suboptimal at 66 when the state pension starts. A plan built around two incomes may need to change if one partner's circumstances change. The tax landscape itself changes. Allowances, rates, and pension rules have all shifted in recent years and are likely to continue shifting. Reviewing your withdrawal plan every year, ideally before the start of each tax year, is essential to keeping the strategy aligned with your actual position. As with all retirement tax planning, the specific numbers matter enormously. The right drawdown amount for someone with a $250,000 SIPP and a full state pension is completely different from the right amount for someone with a $700,000 SIPP, a partial state pension, and rental income. The strategies I've described in this video are frameworks. They need to be applied to your specific income picture to produce an actual withdrawal plan. This is exactly what the drawdown planner inside Retirement Ready UK is designed for. You can enter your pension balance, your state pension forecast, your other income sources, and your retirement age, and it will model your projected annual income, tax position, and basic rate band usage year by year. It uses the current 2025-26 tax figures, including personal allowance and rate bands, and updates automatically when HMRC makes changes. It's a good starting point for understanding your own position before you make any decisions. The link is in the description below. If your pension pot is substantial, say $400,000 or more, I'd also recommend working through these strategies with a regulated financial advisor who specializes in retirement income planning. The cost of that advice is typically repaid many times over in tax saved. Let me come back to the $50,000 figure in the title. That number is based on a realistic scenario. A 61-year-old with a $450,000 SIPP, a 5-year window before state pension begins, and the discipline to fill the basic rate band every year, redirect surpluses into an ISA, and avoid triggering the higher rate band unnecessarily. Across a 20-year retirement, the difference between that disciplined approach and an unplanned one is broadly in that range. For larger pots or higher rate taxpayers, it can be considerably more. The encouraging thing about SIPP drawdown planning is that unlike some areas of tax strategy, it doesn't require complex financial products or aggressive planning. It requires understanding your allowances, your tax bands, and the interaction between your different income sources. And it requires action before the window closes. The years between retirement and state pension are the most valuable years of your drawdown plan. Use them. I've linked the Retirement Ready UK drawdown planner in the description. Run your own numbers and see what your picture looks like. Click the link in my bio to access the free retirement planning tools. Hit like if this was useful. Subscribe for more UK retirement planning content. This is exactly what this channel is about. I'll see you in the next one.